Good morning. You're watching The Opening Bell. I'm your host, Nickey Mirchandani. Well, markets look set for a soft start, if not for a negative one, amidst mixed global cues. SGX Nifty indicates a negative opening for the broader index in India, but Asian markets trade higher, despite bond yields topping 4% overnight. S&P 500 and Nasdaq fell for second consecutive session as yields jumped. Yields firmed up after hawkish comments from Federal Reserve policy makers. In terms of the FIIs and the DIIs trends, FIIs sold shares around 424 odd crore, and also DIIs, however, bought shares to an extent of around 1,498 crore. Well, let us get going and discuss some strategies, stocks and strategies today with Chandan Taparia, the derivative and the technical analyst. In a short bit, but we're just going to quickly address all the movers that we have right now on the list that we have. Of course, we're going to be first talking about Adani group of companies because they continue to be in focus. Also in the limelight will be cement and auto names, which are likely to continue to be in traction. Of course, talking about Adani group, Supreme Court is expected to deliver its verdict on the petition with respect to the Hindenburg report on March 2, which is today. It's going to be delivering in a verdict and setting up a constitution committee with respect to the investor protection. Of course, yesterday also the group has denied the Reuters report of securing around $3 billion from Sovereign Wealth Fund. It's called the Reuters report as false and untrue. An initiation report coming in on L&T Technology, so keep an eye out on this one. This comes from Nomura with a reduced rating and the target of around 3,050 odd share on this one. We are looking at, they say they're looking at the broad-based ER&D service provider. They've gained market share as compared to the pure play players. Of course, it looks at a little challenging macros, which is expected to weigh down on the discretionary spend. But at this point of time, it says that the company's portfolio still looks attractive, given the kind of slowing macroeconomic situation overall. And also we'll be talking about, or also cement stocks are also expected to be in focus. There are two brokerage reports this morning for this space. First one, of course, comes in from Credit Suisse, where it has an outperform rating on Ultratech and neutral on Shree Cement, given the kind of premium valuation which Shree Cement, of course, has been enjoying over a period of time. It says that the sector may be relieved from pressure points, when the pressure points being commodities. Commodity pressure, inflation has been cooling off, which is seen as a bit of positive coming in for these a bunch of cement names. It also notes some amount of pullback in the petcoke prices as well. Says that the demand remains in strong double digit and Adani's capacity addition may be slower. So clearly some positive coming in for cement, at least in terms of the commentary out there. Jefferies, on the other hand, says that if you talk about the month-on-month average price dealer scenario, the price hike remains pretty much flat. There is no major sign coming in terms of the hikes, at least for the month of March. So a bit of mixed view coming in from both of the brokerages, CS and Jefferies, but do keep in mind that cement stocks are expected to be in focus. We are seeing demand. Whether they'd be able to pass on the price hikes or not remains to be seen. Also, what we'd be tracking today will be Hindustan, Zinc and Vedanta. Now, this one is from ET, where the government has written to SEBI opposing Hindustan Zinc deal with Vedanta. It's not the first time that the government has reiterated the stand against the deal. It is the minority shareholders. It has the stake of around 29.5% in the company. There have been concerns around the $2.98 billion cash deal, which is expected to hurt the center's OFS plans. So do keep an eye out on Vedanta. Now do remember, Vedanta has been sliding for the last 8 consecutive sessions. It remains to be seen. There have been concerns around the fundraising. The report today adds to further pressure, at least the selling pressure. Remains to be seen if there can be recovery coming in for Vedanta shares. Also, commodity basket saw some amount of recovery in previous session trade. Needs to be seen if Hindalco, something like an Hindalco, Tata Steel, JSW Steel, also would be able to sustain that kind of outperformance that it staged otherwise in the dull market. Well, also let's talk about Vedanta Resources closing in that deal to secure around $1 billion loan it is a development which came in yesterday, led to some cheer in the investors, saw some probably recovery. But again, Vedanta shares pretty much ended the day flat in red with losses around. Okay, also let's talk about the overall now auto sales scenario, where there have been better than expected show coming in for commercial vehicles and tractors for that matter. There is an inline numbers which were reported for two-wheelers as well as passenger vehicle segment. Overall, auto segment has been doing rather well in the last 3 sessions. Of course, medium and heavy commercial vehicles also sales have perked up. Overall, the demand seems to be doing well for the bunch of these names, assumably on account of the heavy pre-buying before transition to OBD, which is the two norms recovery. This is expected to come in the next month. There has been some recovery which is witnessed in the passenger two-wheeler segment. However, if you talk about the exports, they've been weak. We've been seeing a weaker export dispatches, which is expected to weigh down further. However, there is a positive demand trend continued in this month too for passenger vehicle segment. On a little bit of cautious note out there, Maruti Suzuki on the other hand has given a somewhat cautious commentary. Shortage of electronic components may have an impact on March 2023 production numbers. All right, apart from that, let's actually quickly toss into the guest, the technical guest, Chandan Taparia from Motilal Oswal, who closely tracks in the technicals and the derivatives. Chandan, good morning. I'm going to start off by asking you about the Nifty levels and the strategies now that the investors can be looking at. You think, with the kind of recovery that we saw in the previous session, that will sustain and the Nifty would be able to surpass that 17,500 mark in today's session?
Good morning. Thanks for having me. So yesterday, the Nifty index, which was continuously making lower highs, lower lows, has negated the same and witnessed good recovery. It managed to close near to 17,442, and now the follow-up is required. So on immediate basis, we have support near to 17,350. If market manages to hold 17,350 and moves beyond 17,442, then I think this momentum can extend to 17,620 to 17,777 level. So those who are holding the long positions closely keep the trailing support near to 17,350. If after the small negative opening, if market manages to hold those levels, then definitely we can look at higher side. Now, if you look at the Bank Nifty, that is comparatively outperforming, and hold of the Bank Nifty is also the reason that why the Nifty has negated and turned positive after the weakness of last 8 to 9 days. So Bank Nifty has to hold 40,500 zone to extend this move towards 41,000 marks.
All right. Also, what do you make out of the Reliance and Vedanta right now? Vedanta has seen quite some drubbing in the last previous 8 sessions. Fundraising concerns prevail. We've been seeing slew of reports coming in this one also this morning. What do you make out of it, and also your levels on Reliance Industries?
Yeah, so first, if I talk about the Vedanta, the stock is in pressure. However, on the last trading session, we have seen good recovery, but trend is quite shaky if I look at the weekly chart. So a conditional trade setup is clearly visible here. We have key level near to 288. If Vedanta moves about 288, then we can see some bout of short covering towards 300 zone. While on the downside, support exists at 270 level. Now, if I talk about the Reliance, just a couple of days back, Reliance took support near to 2300 and then headed to 2460 marks. That was the 50-day exponential moving average. But of late, in last 7 days, it has turned lower and again taking support near to 2300 level. So 2300 is the again level to get a bounce towards 2420 to 2460 on the higher side in Reliance Industry.
All right, Chandan, top 3 profitable calls that you can make for our viewers, something that is around the breakout levels or looks interesting in terms of the candle chart approach or whatever strategy that you're adopting right now?
Yeah, so I'll focus on the capital goods name. So first trade would be buy on ABB. This stock is trading near to its lifetime high territory. Recently given a breakout from its pole and flag pattern, decisively holding well above its breakout of 3220, 3230 level. So because of that, positive momentum could be there in the counter. We have support near to 3260. Stock can rally towards 3400 level. Apart from ABB, we believe that counters from selective private banks are bottoming out. So Axis Bank will be on radar. Recently, it has bottomed out with support of 830 and forming some sort of double bottom formations. On last trading session, it formed a bullish candle. So with support near to 850, one can play the move towards 890, 900 level in Axis Bank. So ABB is one, Axis Bank is the other name one can keep on radar. And apart from the defense stocks could be in focus, we like HI and most of the defense name. So here we have support near to 2630. HL has potential to rally to us 2750 to 2800 level. So capital goods, selective defense, and few private banks are bottoming out in this market scenario.
When you say few private banks are bottoming out in this current market scenario, of course, you've spoken about Axis Bank also being one of those. Any other picks that you'd like to, have on this in this space? Because we've seen significant amount of underperformance coming in from overall bank Nifty index. What do you make out of it? And, more names coming in at this point of time. PSU banks, do they look any attractive?
So if you talk about PSU bank, then I'll focus on SBI. At the time of budget, the stock has declined to 500 level. And if I look at the bigger time frame, the stock moves in between 500 to 630 kind of level. So at the beginning of the Feb, it took support near to 500 and recently it made bottom near to 510. So some sort of buying interest is clearly seen near to 500, 510. So I believe that support already has taken by the counter and we can bounce towards 565. So SBI will be the preferred name comparatively if PSU banks are bottoming out in the markets.
Chandan, what is the kind of strategy you really think viewers and the traders could be now be looking at? Do you still think that it is a sell on rally market? The kind of amount of, market managed to eke out small gains in previous session, right? You think this trend is likely to prolong, or it was just a one-off? What are the charts indicating right now?
So if you look at the chart setup, the index which is continuously making lower highs, lower lows has indicated the same. So, but the good part is Bank Nifty is forming the higher lows and consolidating and respected to its budget low. So comparatively, Bank Nifty is more stronger than the Nifty index. So we have seen one day's reversal in Nifty and now the follow-up is required. So as I mentioned that 17,442 is key level. You let it hold beyond 17,442, then the negativity will go out, negativity will nullify, and market will have the scope up towards 17,620 to 17,777. So earlier we were having continuously negative view on the market, but the way Bank Nifty has turned from key support and Nifty has negated lower highs, lower lows, we'll be with positive to range bound and we'll go with buy on decline stance in the market with more positive bias and stance in the Bank Nifty.
All right, so we'll just wait on the sidelines for the market to open and address the market opening quickly for the viewers out there. Do remember that the trade setup right now looks a little mixed. Asian markets were trading higher, but SGX Nifty indicated somewhat negative start coming in for the markets. Let's look at how the markets have been faring right now. Nifty 50, we are seeing red start again, 0.1% out there, somewhat flattish to negative bias, if not for completely negative undertone. Nifty Bank Nifty Index, again, there is a flattish to negative bias out there. Clearly no support being lent in from Bank Nifty. Remains to be seen. It's, of course, a weekly expiry day also, so some amount of volatility is expected to creep in our markets as lackluster as this. Broader index, 0.1% gone on that one as well. So no broader index participation on this one. Small cap index somewhat seems to be holding up in green with positive bias, but remains to be seen if that momentum can continue overall in terms of the sectoral index and the gainers and the losers. Probably we could look at something like a Nifty Auto Index where it's one of the top losers that we have. We're looking at 0.2% gone out on this one. Metal Index, which was seeing some amount of recovery today, down and out by more than 0.5% in trade. And also, if you talk about the Pharma Index, that's where probably the traction is coming in. Flattish trend out there clearly, but FMCG Index, that's the positive bias coming in on that one. Flattish trade, nothing sort of a day looks like it, indecisive right now, not dictating any trend. Nifty 50 is the flattish market. Chandan, I'm also going to address in some of the Nifty 50 top gainers and losers that we have on our list for that matter. Let's quickly look at that. Chandan, but before that, what do you make out of a flattish market like this? What kind of trades can be undertaken in markets as flat as this? Do you expect the momentum? Do you think Nifty would be able to surpass that 17,500 kind of level, or that looks like a difficult task in markets lacking momentum like now?
So what I believe that comparatively buying will be there because Bank Nifty started to hold again. And the good part is that Nifty is still having the some room and clear support near to 17,350 marks and holding near to 17,442. So I'm just closely looking, let it hold beyond 17,442. Then definitely you'll head to a 17,500 or even 17,620 kind of level. So as of now, the way the data setup are being formed and selective heavyweights are holding with the bank Nifty performance, I believe there are high potential that Nifty can head to a 17,500 plus level. Now, stock wise, we talked about capital goods name. We discussed about name of ABB, Siemens, Cummins. I believe L&T is also bottoming out. The lower lows of last couple of days is negated. So with support of 2100, one can play the positive stance in L&T. So that could be the one fresh ideas going forward. So better to be with selective capital goods name. L&T can be added. Nifty let it hold above 17,442, then play the bullish stance of the market.
All right, Chandan, we saw some amount of top gainers coming in from the metal space overall. Cement space also was doing well. UltraTech Cement seems to be doing well. Tata Steel, JSW Steel also seems to be. Hindalco, for that matter, was one of the top gainers that we saw on the list today. What do you make out of this metal counters per se? Do you see any amount of traction coming in on these ones? Like, you know, we've seen quite a volatility playing out overall for the commodity basket. But what do you make out of it?
So actually, when recently most of the metal stocks have fallen down, huge short built up and cold writing was noticed in all these stocks. So, and these stocks have turned quite volatile, making lower top, lower bottom. So I'll avoid, in fact, either I'll go with sell on bounce. And if Nifty holds higher, then I'll avoid these name. Because of the short covering, some bounce could be there, but it would be tough to trade that bounce because somehow the shorts are having the grip. Whether you talk about Hindalco, whether you talk about Tata Steel, all these stocks are overall having some pressure at high levels. So I'll look at the counter which are having the potential to generate the alpha and outperformance and resilience in the market.
All right, something for Hindalco. I mean, something like an Hindalco for that matter. Do you think there is a further room to the upside because the fundamental of this company pretty much remains intact amidst the basket of metal counters that we have? Any levels for this one, Chandan?
Yeah. So if I have to turn bullish, then I'll turn bullish only above 425 because 4 days back it gave a breakdown below 425. So let it surpass 425, then only the momentum will be back. Otherwise, that will be the rough bounce. While on the downside, major support goes to 402. So as of now, 402 to 425 is the broader range for Hindalco. Let it surpass the hurdle, then only the bottom will be placed and short covering could be triggered in the stock.
All right, Chandan, we'll leave it at that. Thank you so much for taking out the time and speaking to us this morning. Right, it's that time of the show where we address the fundamental story of the day. Well, for today, we have Aashish Sommaiyaa, the Executive Director and the CEO, WhiteOak Capital Asset Management, joining us. Aashish, good morning.
Hi, good morning.
All right, there is an intense selling pressure coming in by FIIs. Probably that has abated a little bit in the month of Feb. Participation overall remains very tepid. What do you think in markets like this, because the stance pretty much remains the same when it comes to the hawkish undertone in the US? What are you making out of markets like this?
I think when we speak to, investors as well as advisors, mutual fund distributors, intermediaries, we do find that, there is some kind of, you can say that indifference or some kind of, defensiveness setting in for sure. Because if you see last 1.5 years, more or less, barring a few sectors or barring couple of sector rotations, more or less one can assume that last 1.5 years, client portfolios haven't seen any returns coming through. So I think that is something which always causes people to, rethink. I mean, intuitively we know, or, on a contrarian basis, we know that these are the times when things become cheap. But the reality is that because of, the news flow, like you were alluding to, because of news flow and because of last 1.5 years of kind of going nowhere, you can sense that people are on the sidelines, and you can sense that, some kind of despondency is setting in.
Clearly, but Aashish, at this point of time, with the kind of FII sell-off that has come through, of course, most of them have been overweight in financials, and the kind of underperformance that has come in financials is also because of the selling pressure. But do you think financials will bounce back anytime soon? Do you look at the sector still as to be a reasonably valued sector?
See, I think that, you can always make a case that, in fact, last year also there was data which was kind of publicly available, which said that for over $22 billion of FI selling for the calendar year, I think about 19 billion was financials and IT. So yes, you can always make the case that some of it is because of technical factors, like, wherever there is a preponderance of holding, obviously when there is outflow, that is what will get sold and that is what will relatively underperform. And there is a sound reason for that, because, if you see, financials and IT are known for good governance, known for professional management, much higher relative free float. So because of those technical factors, you can see it. Now, on the other hand, if you expect that FII flow is going to turn significantly positive in the near term, if one were to expect that, then it stands to reason that these sectors will at least see a lift off of all those technical pressures, and these sectors will see relatively better recovery. But if you ask me, I don't think that anything is going to change in a jiffy as far as markets are concerned. The reason being that, for example, last year we saw huge FII selling, and that was largely related to global emerging market selling. And this year also we have seen significant FII selling. In the early part, India was underperforming, but in the last few days, China and all those markets have also let up as far as their rally is concerned. So I don't think that the FII flow is going to change in a hurry. I think two things are still weighing on the minds of markets. One clearly is interest rates, and like the cliched statement goes, interest rates definitely act as gravity for earnings and multiples. So clearly, till the time there is no clarity on interest rates globally, we are going to see this kind of indifferent movement. That also impacts FII flows. And second is obviously that the geopolitics is not clearly behind us. So if you really ask me, next 3 to 6 months, you are going to see more of what you have seen in the last year or so. And I don't think anything is going to change dramatically. Yes, like I alluded to before, if you are a contrarian thinker, if you are a different thinker, then you will keep an eye on valuations, you will keep an eye on price to free cash flow kind of metrics, and you will find that the market is becoming more and more attractive. But definitely one should not put any terms and conditions that market has to bottom out. I don't see it immediately turning the course.
Ashish, what if you are a contrarian thinker, and what if our traders are contrarian thinkers? Which is the sector which looks attractive at this point of time, given the valuation perspective?
So no expertise on trading. I really think, I was listening to the previous section of your show, and like Chandan was mentioning, I don't think that there are any clear, like he said, he's waiting for certain signals, and I'm not an expert at trading or at technicals, so I won't venture there. But what I was more alluding to is that next 3 to 6 months, if anybody has been on the sidelines for the last year or two, and next 3 to 6 months will actually be the opportunity to build your portfolio with the next 18 to 24 month kind of perspective, because things are getting more attractive, things are getting cheaper. I know we are personally, if you ask me, neither me nor my company, we are not a sectoral investor. But due respect to your question, if you were to ask me about sectors, then I would say that, everything to do with financials, everything to do with private sector capex, everything to do with discretionary consumption. I know right now it's under a cloud, and of course, parts of IT. And pharma. So, I would expect some bit of sector rotation in the market. And the stuff which I named, which I think is becoming cheaper, is what I would focus on.
All right, Ashish, I pretty much get that you follow a pretty long-term scenario and not something which is momentum clearly in nature. With that in perspective, at the start of the year, I remember having a conversation with you around how the market behavior is likely going to be, where you suggested that the first 3 to 6 months apparently are going to be the week, or nothing is going to change or dramatically be positive for Indian equity markets. And it's the second half per se, where we probably might see signs of recovery, if I still remember that. Does your commentary change anytime soon for that one, or are you seeing more weakness and factors building in? How do you look at the situation right now?
No, yeah, I definitely remember that conversation in January. And as you might have gathered from my earlier comments, I don't think anything has changed as far as my perspective. I mean, nobody can really forecast these things, but at any point in time, whenever we are asked a question, we are just trying to do our best to get the lay of the land and then try to, hypothesize what is the most likely probability of how things would play out. So from that perspective, what we spoke in January versus what we are speaking now on 2nd of March, I don't think anything has changed. I still believe that, and like I just mentioned, I still believe that nothing is going to change in a hurry. But yes, I would be more constructive once we have more clarity on interest rates, once we see something settling as far as geopolitics, at least there should be no escalation out there. I think once these things change, or maybe latter half, which I think by latter half of 2023, I'm more hopeful. So I would hold that stance.
All right, Aashish, it's going to be a little short-sighted question again, and not probably the long-term story that you could be looking at given the kind of fundamentals that you usually like to follow. But just from a very market perspective mood, we've seen sectors like hotels doing well, we've seen innerwear stocks doing well. What do you make out of sectors like these? You think there's still a value buy and they kind of indicate the kind of consumer discretionary taste or the mood underlying fundamental of the markets? How do you look at the two space, innerwear and hotels for that matter? Do you see any kind of traction in there?
Yeah, I think, obviously all of us, all market participants need to kind of take some time and segregate how much of it was the post-COVID bounce back or cliched what you call pent-up demand, because travel kind of came back with a vengeance. And if things remain lackluster, right now you can see a sense of despondency as far as markets is concerned. And if you consider that markets are forewarner of some kind of economic conditions in the near term, then I would expect that, all that pent-up demand and all that, travel with a vengeance which came back. Also, if you see discretionary spends, I think, we had obviously pretty much 3 waves of COVID and work from home and, disruptions as far as normal life is concerned. So I think 2022, probably we all knew was more a year of bounce back. And in 2023, because the question is more on a shorter term basis. So in 2023, we all have to figure whether this pent up demand or this travel with a vengeance, is it going to sustain or not? If you were to look at stock market and if you were to look at any economic forewarners, I would say you should be cautious and you should not extrapolate what you saw in 2022. Moving on to slightly longer, like 2-3 years, 5 years, I think these sectors are going to do very, very well because they are directly correlated with potential uptake in per capita income and potential GDP growth and whatever economic prospects we speak about India. I think so from that perspective, these are discretionary consumption sectors. 3 to 5 years, one would be constructive. But if you're asking me only about 2023, then I would not extrapolate what happened in 2022 and I would watch for sustainability.
All right, Aashish, let's take an aerial view on the auto space then, Let's look at how the last 5 years performance has been. We're looking at the valuation pressure clearly. I mean, valuation at this point of time seemed to be reasonable, but then the earnings probably were in doldrums for this company for the last 5 years. This time around, the sentiment seems to be changing a little bit. Foreign brokerages in the last 1 month have just taken a 360-degree turn from their view on the auto space overall. Do you make anything out of it?
I would just say that you should not extrapolate the last 3 to 5 years because last 3 to 5 years in auto, and if you specifically see the trouble started from 2018. So if you go back to 2018, I think some of these things are totally forgotten now. That even before COVID, auto was in a kind of in the doldrums. Why am I saying that? Because 2018 is when oil went to $88, and after that, policies related to registration costs for vehicles, insurance costs for vehicles, introduction or kind of preponed introduction of Bharat Stage 6, all those kinds of things were already weighing down heavy, and there were floods in some parts of the country in 2019 early, if I remember. So and GDP growth obviously tanked in FY 19-20. Even before COVID came, India's GDP growth was 3.7%. And in 2019, we even had a credit crisis where certain banks and NBFCs were in deep trouble. So all of those things impacted auto right through 2018-19. And I think COVID came after that. So, that was the kind of back-breaking event. So I would say that if you're looking at, auto, and if you're looking at, say, auto in 22-23 and, using the base of 2018-19-20, I think it'll be very, very misleading. So I would say that, you should blank out 2018-19-20 when you're talking about auto. Coming to the other important point, now, obviously there is some rosy picture or there is some positivity, and my personal opinion that positivity should sustain. There are reasons for this. I think that if you see in the recent past, it has done very, very badly. And people have kind of lost sense of what base to compare or what the real market size or what type of demand is actually shaping up. That's why people are getting surprised on the positive. The other important thing to keep in mind is that there is this sense that, there is huge spending on infrastructure and roads and stuff. And I think that would always get correlated with people buying more vehicles in the medium term. Again, I'm not talking next quarter 2023, but if you were to allow liberty of the next couple of years, I would say that the enthusiasm would sustain as far as auto as a sector is concerned.
All right, Aashish, what do you make out of overall of the commodity basket? Something like a Vedanta has been in news for the fundraising plans. There have been a couple of concerns out there. Government has been not okay with the deal between Hindustan Zinc and Vedanta. Of course, a sharp drubbing has been witnessed on this one for the last 8 consecutive sessions. But how do you look at overall commodity space and Vedanta in particular?
So, we are not big investors in commodity really. I think nothing to do with one individual company or one individual group. The reality we feel is that if we claim to be bottom-up investors and if we claim to hypothesize cash flows of companies, then I think, forecasting global commodities is kind of slightly beyond the remit. Of course, we do end up owning some commodities when we feel that there is, a big traction in the market purely. So as a matter of risk control or as a matter of controlling deviation from our underlying benchmarks, tactically we do end up owning sometimes, but on a fundamental basis or on a long-term basis, we actually don't have exposure to any global commodity. And not because we think they will not make money, but because we think that if you're a bottom-up investor, if you claim to hypothesize cash flows, then very, very difficult to own global commodities. So that has been our stance. And if you really ask me for now, if one of the prime concerns for the world is that we are going to witness a significant slowdown, then I don't see why there should be consistent buoyancy in global commodities. So a lot of times I think financial speculation, bet on inflation, bet on reopening in China, all those kinds of things from time to time result in financial speculation. But if you ask me, bottom up, I don't see sustainability of commodities.
All right, Aashish, we'll leave it at that. Thank you so much for taking out the time and speaking to us this morning.
Thank you.
All right, with this, it's a wrap. Thank you so much for tuning in.